Imagine a world where money stopped making sense. A time when the very thing we rely on to exchange value, to buy goods, to pay for services, just vanished. It sounds impossible, right? But, in reality, there was a moment in history when money stopped being real, and what happened next changed the course of the global economy. And here's the kicker, it's happening again today, in a way that we don't fully understand. When did money stop making sense, and what does it mean for all of us? Stick around as we unravel a story that connects history, economics, and our future in ways you might not expect. Before we dive into the mystery, let's step back and look at the origins of money. You see, money wasn't always the paper or digital numbers we use today. It started as a tangible object, gold, silver, even cowrie shells in some parts of the world. Early human civilizations needed a way to exchange goods and services. But what happens when that object of value itself no longer holds value? The first big twist in this story occurred in the early 20th century, during a series of financial events that were so dramatic. They left the world questioning the very foundations of the financial system. World War I and the Great Depression set the stage for the moment when money, as we know it, was forever altered. We're talking about the gold standard and the decisions made by central banks, decisions that broke the back of traditional money systems. Let's start with the gold standard. For centuries, nations tied the value of their money to gold. This meant that you could, in theory, exchange your paper money for gold at a fixed rate. The value of currency was directly connected to something physical and scarce. But as wars raged and economies shifted, governments began printing more money than they had gold to back it. World War I marked the first cracks in this system, but it was during the Great Depression of the 1930s that the full collapse of the gold standard began. When President Franklin D. Roosevelt took office in 1933, the US dollar was still technically tied to gold, but the US government was hemorrhaging money. The Great Depression had devastated economies, and FDR's New Deal policies required huge amounts of federal spending. So, the US government began doing something radical. It started to print money without gold backing. But this wasn't just any normal printing of money. It was a fundamental shift in the relationship between paper money and tangible resources. In 1933, the U.S. government issued an executive order that required citizens to hand over their gold to the Treasury in exchange for paper money. Citizens were ordered to exchange their gold coins, gold bullion, and gold certificates for $20.67 per ounce. This act marked the beginning of the end for the gold standard. Once gold was no longer tied to the dollar, paper money itself was freed from its physical constraints. This moment was the turning point. Money was no longer tied to something real, something tangible. And that moment marked the beginning of a new age, an age where money itself could be manipulated, inflated, and devalued at will. Fast forward to 1944, when the Bretton Woods Agreement was signed. This was the next big step in the story. During World War II, global powers realized they needed a new financial system to stabilize the world economy. The Bretton Woods system established the US dollar as the world's reserve currency, effectively making it the global standard. But here's the kicker, the dollar was still tied to gold at $35 an ounce, and other currencies were pegged to the dollar. For a brief period, the global economy had a system that, although imperfect, still had a physical grounding in gold. But as the years went on, the US government's ability to print more money without any tangible backing became problematic. The US had been running a trade deficit, and in the 1960s, as the Vietnam War escalated, this only worsened. The cost of war, coupled with domestic economic pressures, pushed the US to print more money than it had gold reserves to cover. By 1971, President Richard Nixon made the fateful decision to completely sever the link between the dollar and gold, marking the official end of the Bretton Woods system. On August 15, 1971, President Nixon announced that the U.S. would no longer convert dollars to gold at a fixed rate. The moment was shocking, and the financial world held its breath. The gold standard had been the bedrock of the global economy for centuries. But now, money was free-floating. It was no longer tied to anything real. With the U.S. dollar no longer backed by gold, it became what we call fiat money, money that has no intrinsic value other than what governments and institutions say it does. The US dollar and other currencies became entirely based on trust and confidence in the government and institutions that issued them. The world economy, as we know it today, was born in that moment, and, ironically, it was also the beginning of a system that would lead to unprecedented levels of financial speculation, inflation, and eventual economic crises. The immediate aftermath of Nixon's decision was turbulent. Within a few years, inflation soared. The 1970s saw stagflation, a combination of high unemployment. Now, let's fast forward to today. Does the modern economy feel disconnected from reality? With cryptocurrencies, stock market bubbles, and the constant inflationary pressures, are we seeing history repeat itself? Is money still real? Or are we living in a world where trust, speculation, and manipulation have taken over? In the next section, we will connect these historical moments to the current state of the global financial system. We'll uncover the patterns that have emerged and explore the financial crises that were inevitable in the wake of these changes. You'll see how the story continues to unfold in ways we may not fully grasp yet. But before we continue, I'll leave you with this question. If money isn't tied to anything real anymore, what happens when the trust in the system breaks down completely? We've already established that when Nixon severed the link between gold and the dollar, money itself became a concept. What does that mean for us today? If money is no longer tied to something physical, can it be trusted? And if the system can be manipulated, what happens when the trust in it starts to break down? Let's rewind a little to the 2008 financial crisis, a direct consequence of this system. For years, financial institutions were creating more and more abstract forms of money, mortgage-backed securities, derivatives, and other complex financial products. These products, built on speculative value and not tangible assets, became the backbone of the global economy. But as the housing bubble burst, it exposed just how fragile this system really was. The crisis revealed something crucial. Financial systems that are based on trust, not something real, can collapse when the people lose faith in them. In 2008, the world witnessed the ultimate collapse of this illusion, leading to a global recession that affected millions of lives. The 2008 crisis wasn't just a wake-up call. It was a loud alarm ringing through the global financial system. Banks had over-leveraged themselves, taking on too much risk with bad loans that were repackaged and sold as secure investments. These safe investments turned out to be anything but. And the collapse of major banks like Lehman Brothers sent shockwaves throughout the global economy. The irony, the crisis happened because money, in its modern, digital form, was no longer a reliable measure of value. The system, built on trust and speculation, failed spectacularly. It wasn't gold or even the government that kept money valuable anymore. Instead, it was a belief in the financial system itself, which crumbled when reality set in. Governments responded by bailing out banks, printing money, and propping up failing institutions. But the fallout left people disillusioned with the financial system. So what did we learn from the 2008 crisis? The obvious solution was to reform the banking system, to tighten regulations, and to create a more stable financial system. But the fixes didn't work as well as planned. Yes, some regulations were put into place, such as the Dodd-Frank Act, but the root cause of the crisis wasn't just bad regulation. The core issue was that the financial system was still built on speculative, abstract value. No matter how many rules are in place, the underlying problem remained unsolved. Even after the crisis, money didn't return to something tangible or real. Instead, central banks adopted extreme measures like quantitative easing, essentially printing more money to keep the system afloat. But here's the catch: these measures didn't fix the fundamental issue. They just kicked the can down the road. As the global financial system continued to sputter, something new emerged. Cryptocurrencies. Bitcoin, the first decentralized digital currency, was created in the aftermath of the 2008 crash. For many, cryptocurrencies represented a new hope, a currency free from central banks, inflation, and government manipulation. But here's where things get tricky. Cryptocurrencies are, in many ways, the perfect example of modern money's disconnect from reality. They don't represent any physical value. They're not backed by gold or anything tangible. Instead, their value is based purely on belief, the belief that people will continue to trade them and use them. And that belief is fragile. The volatility of cryptocurrencies, with dramatic price swings, shows how easily this money can lose value. Cryptos, much like fiat money, rely on trust. If that trust falters, we could see another financial crisis, but this time with a completely new and unpredictable set of players. Another troubling sign is the resurgence of speculative bubbles. The most famous example in modern history is the housing bubble that caused the 2008 crisis. But we've seen similar bubbles form since then, in tech stocks, cryptocurrencies, and even art and collectibles. These bubbles are created when people start inflating the value of assets, often without regard to their true worth. For example, in the late 1990s, the dot-com bubble burst as investors poured money into tech startups, inflating their stock prices far beyond their actual value. Today, we're seeing a new wave of speculative bubbles, with assets like NFTs and meme stocks rising in value because of pure hype and speculation. These aren't based on anything tangible. They are entirely driven by belief, or more accurately, by a lack of skepticism. This isn't just limited to individual investors, even governments are falling into this trap. Take, for example, the massive levels of debt racked up by countries around the world. As nations continue to print more money, they accumulate more debt, creating an unsustainable system that could eventually collapse when people stop believing in it. The troubling reality is that the financial system today is eerily similar to what led to the Great Depression and the 2008 crisis. The global debt has three takeaways. So, what does all this mean for us today? Here are three key takeaways. 1. Money is still unreal. The financial system today is still based on belief, not on tangible value. Whether it's fiat currency, cryptocurrencies, or speculative assets, trust is the only thing holding it all together. If trust erodes, so does the value of money. 2. The system is fragile. Our current financial system is fragile. Just like in 2008 and the 1930s, when something breaks, it can have catastrophic effects. The high levels of debt, inflation, and inequality create a volatile environment that could lead to another financial crisis. 3. We're repeating history. The patterns we saw in the Great Depression, the 1970s, and 2008 are repeating themselves today. Speculation, debt, and inequality are all present and growing. Unless we address these issues, we're setting ourselves up for another collapse. Here's the open-ended thought. If money is no longer real, what happens when trust in the system evaporates? Could we be headed toward another moment in history where the very concept of money itself becomes irrelevant? And what will it take for us to realize that we need a new way forward before it is too late? The world needs a financial reset, a new system built on real value, not just belief. But will that reset happen in a controlled manner, or will it be a crash we can't recover from? I want to hear your thoughts on this. Do you think the financial system can continue as it is, or are we heading for another crash? Leave a comment below, and let's continue this conversation. If you found this video insightful, don't forget to like and subscribe for more in-depth analyses of the global economy. And as always, stay curious and stay informed, because the truth is, the more we understand how money works, the better prepared we'll be for what happens next.